Hello everyone, this is Energy Brief with Peter, and I am Peter Okediya. Today we shall be examining the fiscal reforms introduced by some enactments for the Nigerian energy sector. On the 12th of March 2022, Energy Brief with Peter had a webinar with Mr. Suraj Oyewale, a fiscal and public policy expert. He addressed three major enactments, namely the Petroleum Industry Act, the Climate Change Act, and the Finance Act 2021. This video will examine the key fiscal issues discussed during the webinar and also afford us to be well abreast of this regulatory development in the energy and oil and gas sector in Nigeria. Renewable energy and renewable energy. Renewable energy is energy generated from sources which occur naturally and repeatedly in the environment. Such sources are the wind, the waves, the sun, biomass, landfill gas, and the tide. Non-renewable energy are finite resources and their production cannot be sustained for a long time, coupled with the fact that they also have their environmental cost. Such sources are coal, natural gas, and crude oil. A wave of laws. The Climate Change Act 2021 was enacted in November 2021. The Petroleum Industry Act 2021 was signed into law on the 16th of August 2021, while the Finance Act 2021 commenced on December 2021. The Climate Change Act is described as a legal framework to drive Nigeria's economic development in a sustainable manner through adaptation and mitigation. At the COP26, Nigeria committed to achieve net zero by 2060, and the Climate Change Act was signed into law a week after the conference. Highlights of the Climate Change Act. First, Section 3 of the Act establishes the National Council on Climate Change, which is empowered to make policies on all matters concerning climate change in Nigeria. This council, in conjunction with the Federal Ministry of Environment, Budget and National Planning, will be responsible for formulating Nigeria's National Climate Change Action Plan every 5-year cycle. The action plan will include details about Nigeria's carbon budget, greenhouse gas emissions profile for sectors of the economy, incentives for private and public entities that achieve their greenhouse gas emission reduction targets, and so more. The Council will also address the National Climate Change Policy introduced by the Federal Ministry of Environment in 2021. Now, the scope of the application of this Climate Change Act covers MDAs, that is, ministries, departments, and agencies of the federal government, and public and private entities. Private entities refer to entities that employ 50 or more employees. They are required to put in place measures to achieve the annual carbon emission reduction targets. They are also required to designate a climate change officer or an environmental sustainability officer. Failure to comply with this obligation will result in fines determined by the NCC based on the environmental economic accounting. Also, public entities in the Climate Change Act are defined as organizations or bodies providing services to the public on behalf of the Nigerian government. The failure of an MDA to comply with carbon emission targets would result in sanctions of the principal officer of such MDA, including fines determined by the National Council. The Climate Change Act also provides for the creation of the Climate Change Fund, which will warehouse the amounts paid by the way of carbon taxes and emission trading. It will also have in its appropriations from the National Assembly. and funds from international organizations alongside fines and charges. The proceeds of this climate change fund are to be dispersed towards funding climate change mitigation initiatives. A major fiscal highlight in the Climate Change Act is the carbon tax. A carbon tax refers to tax directly linked to the level of carbon dioxide emissions. And then it is provided under Section 4J, that's Section 4, Paragraph J of the Act, that the Council shall collaborate with the Federal Inland Revenue Service to develop a mechanism for carbon tax in Nigeria. More about the carbon tax will be reviewed later on in this video. The second carbon pricing mechanism that is introduced by the Climate Change Act is called emissions trading. Section 4 provides that the Council will collaborate with the Federal Ministry of Environment and the Ministry of Trade to develop and implement a mechanism for carbon emission trading. Emissions trading, or cap and trade, is a government-mandated market-based approach to controlling pollution by providing economic incentives for achieving reductions in the emissions of pollutants. The most common system is the cap and trade. To incentivize firms to reduce their emissions, a government sets a cap, that is a limit, on the maximum level of emissions and creates permits, otherwise known as allowances, for each unit of emissions allowed under the cap. Emitting firms must obtain and surrender a permit or an allowance for each unit of their emissions. They can obtain these permits from governments or through trading with other companies. Based on these features, it is commonly referred to as the market-based mechanism. Now, to the issue on carbon taxing. A carbon tax refers to tax directly linked to the level of carbon dioxide emissions, and it is often expressed as value per ton carbon dioxide equivalent. It is different from an emission trading system in that the emission reduction outcome of a carbon tax is not predefined, but the carbon price is. Carbon tax is a fee imposed by the government on the burning of oil and gas. It creates a significant monetary disincentive to transition to clean energy across the economy if it is set high enough, simply by making it more economically advantageous for oil and gas companies to switch to non-carbon fuels and attain energy efficiency. Carbon tax can be imposed at any level in the oil and gas supply chain. Administratively, the preferable method is to levy the tax at the upstream, because carbon dioxide emissions of the various fossil fuels are still known at exploration and production stage. The tax might also be imposed midstream or downstream, but the common method, like I've said, is the imposition as the upstream. The objective of a carbon tax is to divert consumers from products or behaviors with high levels of greenhouse gas emissions, because the more greenhouse gases a product emits, the more it is taxed. Now, carbon tax is currently in place in over 30 countries of the world. The use of explicit carbon taxes in the European Union, which directly puts a price on carbon dioxide emissions, has increased over time. In 2008, 7 European Union member states levied explicit carbon taxes, and currently 14 EU member states have carbon tax, differing widely from 0.1 euros per ton of CO2 in Poland to over 100 euros per ton It is noted that these taxes do not usually apply to sectors already covered by the EU carbon trading system, also known as EU ETS. The implication in carbon taxing is that it forces oil and gas companies to adopt environmentally friendly alternatives. It may also increase economic cost on consumers because it will add the price to products and services that pollute the environment. A major thing we should note is that carbon tax is different from carbon border tax. A carbon border tax is a duty imposed on imports based on the amount of carbon emissions resulting from the production of the product in question. So it is really different from carbon tax, although similar in ideology. Next, the Act, that is the Climate Change Act, requires the Council to work with the Federal Inland Revenue Service to come up with carbon tax mechanism. Its form is not known yet, but it is sure that the funds that is derived from carbon taxing may be used to finance the Climate Change Fund. Going to the second Act under review, Petroleum Industry Act 2021. The new fiscal provisions under the PIA will only apply to acreages granted under the PIA and existing acreages that have either been renewed or converted. Chapter 4 of the PIA, titled Petroleum Industry Fiscal Framework, establishes the fiscal framework of the Nigerian petroleum industry. Then will give us a highlight of fiscals in the Petroleum Industry Act. There will be new royalty rates for upstream crude production, which will be based on terrain production and price. Based on terrain, royalty for onshore areas is at a 15% rate on their chargeable volume. Then shallow water acreages have 12.5% rate on their chargeable volume. Deep offshore have 7.5% rate on their chargeable volume, and frontier basins have 7.5% rate on their chargeable volume. In the gas subsector, gas royalty rate is reduced to 5%. Here, a royalty rate of 5% will apply for natural gas and natural gas liquids production. This is further reduced to 2.5% where the natural gas is produced and utilized in Nigeria. The Petroleum Industry Act also introduces a dual tax regime in the form of company income tax and hydrocarbon tax. Upstream operations is now subject to company income tax at 30% of profit oil, while hydrocarbon tax is introduced to replace the petroleum profit tax. The hydrocarbon tax applies to crude oil, condensates, and natural gas liquids from associated gas operations. It is charged and assessed on profits from crude oil on such operations in each accounting period, and it is applicable to all companies in the upstream sector. You can find this in section 261 of the Petroleum Industry Act. Hydrocarbon tax is applicable to converted or renewed onshore and shallow offshore acreages at 30% and to onshore and shallow onshore, including marginal fields acreages, at 15%. You should take note that hydrocarbon tax will not apply to companies with investments in deep offshore areas. Another fiscal issue under the PIA resulting from the dual tax regime is that cost-price ratio is capped at 65%. This means cost available for tax deduction is limited to 65% of the gross revenues at the measurement point, meaning tax reduction of costs is limited to 65 cents for every $1 sales by an upstream oil and gas company. The cost price ratio limit here may be a disadvantage to license holders, as this will limit their capacity to maximize returns, especially during a low price regime. The Petroleum Industry Act also introduces some funds and levies. One of them is the host community levy at 3% of the previous year operating expenses of upstream companies. Section 40, subsection 2 of the Act stipulates that 3% of the actual annual operating expenses of an oil company must be paid to the host communities. This contribution makes up the host communities trust fund. The fund, which shall be set up by the oil company, shall be administered by a board of trustees who shall use the funds for the benefit of the host communities. The host communities, according to section 318, are communities situated in the area of operation of a set law, that is, of an oil and gas operator, and any other community as the oil and gas operator may determine. If an operator commences drilling operation in a community and passes the pipeline and other equipment for oil exploration through two other companies, such company will have three companies in his host community's trust fund, which he has to pay 3% of its annual operating expenses into. More so, to address the challenge of mismanagement of funds by host communities, the Act directs that the operator set up a board of trustees who shall manage the host community trust fund for the benefit of the host communities. From the 3% contributed to the host communities, 75% of it must go into infrastructure and projects within the host communities. 20% of the fund will serve as a reserve fund, and 5% will be used to running the trust by the board of trustees. In addition, the PIA establishes the midstream and downstream gas infrastructure fund set up by the government to promote equity investment in the midstream and downstream gas infrastructure. 0.5% of these funds will be from petroleum products and natural gas sold in Nigeria. Money received from gas flaring penalties will also be transferred to the midstream and downstream gas infrastructure fund for investment in infrastructure within the host community. In addition, the PIA introduces the decommissioning and abandonment fund. An operator must set up and maintain a decommissioning and abandonment fund with a financial institution that is not related to the operator. The amount to be contributed will be based on the decommissioning and abandonment plan provided to the regulator, whether in the upstream or in the downstream, or in the midstream rather. Another important provision is the conversion of licenses, because upstream operations will now be operated under new 3 classes of licenses to be granted by the Nigerian Upstream Regulatory Commission, namely the Petroleum Exploration License, the Petroleum Prospecting License, and the Petroleum Mining Lease. Current OPL or OML holders have the option to convert their subsisting interest to a PPL or PML under the new regime through a conversion contract in order to enjoy the fiscal incentives under the new regime. The modalities for the conversion contract are not clear yet, so the regulator will be expected to issue out some modalities anytime soon. So that's for Petroleum Industry Act. Then lastly, the Finance Act. The Finance Act 2021. The first fiscal issue we'll be looking at under the Finance Act is the Naseni Act levy of 0.25% PBT. The Finance Act amends the National Agency for Science and Engineering Infrastructure Act by placing a levy at rate of 0.25% on profit before tax of commercial companies and firms in the oil and gas sector with turnover of 100 million naira. In addition, the tertiary education tax, which was previously levied at the rate of 2%, will now be levied at the rate of 2.5% on the assessable profits of companies registered in Nigeria, excluding small companies. And then, really mostly relevant to the oil and gas sector is the tax holiday for gas utilization activities, streamlined in the sense that it provides an initial tax-free period of 3 years for downstream gas utilization, which may, subject to the satisfactory performance of the business, be renewed for an additional period of 2 years. This incentive is claimable not more than once by the same company. Also, it shall not apply to any company that has claimed an incentive for trade or business of gas utilization in Nigeria. Other fiscal issues can be seen in the VAT, that is Value Added Tax Modification Order of 2021, which was signed on 30th of July 2021 by the Minister of Finance. This order has exempted gas supplied within the power sector value chain from value added tax. However, gas supplied to the commercial sector, those that use gas as fuel, and gas-based industries, those that use gas as feedstock, such as petrochemical and fertilizer plants, will remain value added taxable. That is, value added tax will still apply to them. And most importantly, for the energy sector in general, the VAT Modification Order exempts renewable energies from value added tax. This is in line with the intention of the federal government to increase the supply of renewable energy electricity from 13% of total electricity generation to 23% in 2025. And by 2030, renewable energy equipment, which was introduced as an exempt item in 2020, remains value added tax exempt. That is, value added tax won't apply to renewable energy equipment (REE). This demonstrates the federal government's commitment to attracting investors or investments to the renewable energy sector, which is usually very capital intensive. This will go a long way in helping the country meet its nationally determined contribution and aimed at reducing greenhouse gas emissions by 20% unconditional and 45% with international support by 2030. So, this video summarizes the webinar where Mr. Suraj Oyewale addressed all these issues under the Petroleum Industry Act, the Climate Change Act, and the Value Added Tax Modification Order, all in 2021. Follow Energy Brief with Peter for more webinar updates and insights. Do not forget to hit the subscribe button. See you next time. Cheers.